Well, good morning, everyone. Welcome to a fresh new week in the markets. This is trading a smaller account. And today we're going to look at three or four different bullish strategies. Why bullish strategies? Well, the market is hitting new all-time highs, and we're trying to go with the flow of the market, of the sectors that are strong, and then stocks that are strong within them. So today we're going to look at a swing target using a stock. We're going to look at swing targets using options. We're going to look at long verticals, and we are going to look at buy right covered calls. So we have got a lot of stuff on the menu today. My name is Barbara Armstrong, and I am delighted that you are joining me. We also have Kevin Horner with us in the chat. He's a friend and fellow coach, and he understands all these strategies backwards and forwards. So if you have any questions, don't hesitate to type them into the chat. As we go along, in between Kevin and I, hopefully we'll have answers for you. If you aren't following us on X, you are missing out, my friends. At Barb Armstrong CS and at Kevin Horner CS, we're posting all kinds of great content that you won't want to miss. We're also now both on LinkedIn, so wander over to LinkedIn and you can find us there as well. Okay, I want to just remind you that we do a lot of options trades in this class, and options do carry a high level of risk and aren't suitable for all investors. So we always go over the risks of any trade before we place it. We're using the Paper Money software application on the Thinkorswim desktop platform. Say that 3 times fast. I got it out once and that's enough for me. But know that there are some nuances and differences. One is that short option positions will never be assigned early. We spent a lot of time in the class on Friday. If you missed it, you may want to check out the archives talking about what happens if something's assigned. I'm going to mention that briefly on one position that we're going to review today as well. I also want to thank each and every one of you who continue to show up every Monday and Friday where we link arms together and we're figuring this out. I'm going to do a very brief market overview because Kevin does a fantastic market overview at the market open at 9:30 Eastern. He did that this morning. You're going to want to check that out. So ours is going to be kind of quick and dirty. We're going to place a bunch of new example trades. And today we're just going to look at managing one trade since we spent a lot of time on trade management on Friday. Although in this class, we might at any given time have somewhere between 10 and 20 active trades going. So this is a very active trading class. Our goal in this class, we place lots of trades and then we follow up on those trades and we have conversations as we go along about as to why we are placing one type of trade versus another, and then how we manage it, how we structure our goals, etc. And so, if you've never been actually to a live event, I'm going to be in Chicago with Kevin this weekend, Joe Mazzola, network personalities. Like there will be a crew there that we've flown in from all over the country. And these market drives, we go from what's happening globally, Strait of Hormuz may come up, just so down to what's happening within our borders. I imagine tariff conversation will be part of that, down to what's happening with the sectors, and then individual stock example trades. So like we'll have the coffee on. It's not too late to register and join us. And then that's followed by Santa Clara, I think, is the following weekend. Registration is now closed for that. If you show up, if you're in the Santa Clara area, we'll do the best we can to find you a seat. That's a 2-day event. And these next 3 events, Santa Clara, San Diego, and Chicago. First day is technical analysis. Second day, intro to options. But these are free to attend. And we'll have the coffee on. We'll provide breakfast. We'll provide lunch at this market drive. There will also be a nice reception at the end of the day. So would love to have you join us for those. Back to this class, we started the year with a $25,000 account. I always reset the account, and it's always a little bittersweet, but we reset it at the beginning of every year. Our max position size is 5,000. And you may be kind of looking at that and say, like, hey, back the truck up. Like, I have $1 million account, and there is no way on this planet that I am going to put, like, that's the equivalent of 20%. And if you had $1 million account, you might say, well, I don't want to put more than 5% of my account in any one position, or you can make your guideline whatever you want, but we wanted to be able to do stock positions and buy right covered calls. And so we made it a $5,000 position. Now our account in this paper money account is now up over 31,000, and we haven't changed this number, and we won't change it, throughout the year. Now this actually, our max risk per trade is 500. And sometimes, given we've had some success in this account, we might go as high as 550, but we're not going to go to 600. And this guideline is not one that we negotiate. We don't say, well, this is a sure thing, so we're going to double our position size, because how many sure things are there in trading? They really don't exist. It was a trick question. And our focus is on the short to intermediate term time frame. We're not focusing on long-term buy and hold in this class. Okay, and we're trading both bullishly and bearishly. Okay, now we haven't done a lot of bearish trades lately because the market is not bearish, but one of our most successful example trading, example years was the year the market really tanked, because we did a lot of very short-term bearish strategies. We've been practicing our bearish strategies less of late because we're trying to do example trades that are congruent with what's happening in the market now. Yeah, the only sure thing is that not every trade will win. So Paul, thank you for saying that. The only sure thing is that some will lose. And that's probably a good way to look at it. Now, if you've only ever placed one trade and it worked out well, good for you. Yeah, but if you trade on a regular basis, there will be some trades, in all likelihood, that do not go your way. So to do our quick and dirty market overview, if we come and we look at the S&P 500, it's hitting a new all-time high today. So it's pretty hard to characterize that as anything other than bullish. It's up 8.4% year to date. And if we come and I say show price as a percentage, in the last year, we're up, 16.5%. So pretty bullish, right? Just nod your head in agreement. There's no sense in arguing with me on that one. Like, as Lee Bull used to say, like, new highs are not bearish. And that the NASDAQ is up almost 25% and hitting a new all-time high today at 25% in the last year, 16% year to date. So yeah, bullish. Now, I characterize this as kind of a bull flag and a bit of a stiff wind. We're within a stone's throw of the all-time high at 495 if you had a decent arm. But, it's up 13.7% in the last year, up a modest 3% year to date, but still looking overall relatively bullish, although it's been consolidating. And we're close to an all-time high on our small caps also. So the Russell 2000 is 2,000 of the smallest companies of the Russell 3000, and it's up, winner, winner, chicken dinner, the most of the four major indices up 30%, up 16% year to date. And then if we look at the VIX, our volatility index, it's popping a little today, but still at 18, like we're well below the 20. And a long, long way from where we were, back here at the end of March. Okay, and then if we want to look at sectors, who's leading the charge? Technology and communication over both the last 4 weeks and the last 3 months, hitting a new all-time high today. I mean, this has just been screaming. And communication, maybe not like looking quite as wickedly bullish as tech, and creating maybe a bit of a bull flag here today, but looking pretty darn bullish too. Hit a new all-time high, intraday high on Thursday of last week, and a new all-time high close on Friday. Okay, so there's our quick and dirty overview. So let's come and look at Nokia, and get ready, because I want you guys to vote on this one. And so here's Nokia. So it's up like uh, in the last 9 months. Well, here's the last year. It's up 100 and almost 165% in the last year. And then if we come in and look a little closer, and so you might say, like, this is really annoying because this closed like at 1292, 1282 on Friday. I should have put in a conditional order. And I didn't. And so like it just keeps on going up, which is annoying me. You know, it's exactly what I thought it would do. Um, you know, like just based on these patterns. But I was, you know, I like to place these trades in class, so it's a little frustrating. It's like, could you just hold on for a cotton picking minute until we get in here? And so here's the thought. This is a $13 stock. Now, you know, if you're not familiar with Nokia, if we come to the Analyze tab, we can see that this is a company based in Finland. Now, when it says ADR here, it means it's not an American-based company. And so what this tells us is that there could be additional risk, like currency risk and that kind of thing. But you know, you might say, well, we've missed it. Well, it's kind of annoying that it's taken off so much today, but might there still be an opportunity for us to both buy the stock and sell a covered call? Now, originally I was going to sell the 14 call. It's now at 13.75. But what if our expectation is that this might continue to move to the upside? And Nokia, what do they sell? Well, they sell like fiber optic technologies, copper technologies, infrastructure, Wi-Fi. You know, when you look at fiber optics, like what does AI use? Like a fair bit of fiber optics, right? Or so, you know, this is a company that's been in demand. You can click here and read some of the analyst reports if you like. We're not going to do that today. But could we come in to the trade tab, and I'll discuss a conditional order later. Somebody's asking in the chat what a conditional order is. So could we come to this 15 strike out just 3 weeks out? So this is a weekly option. So, but you know, if we look at this, we've got almost 5,000 contracts. And if you look at the example trading plan for a buy right covered call, and I'll show you where that is in a minute, you know, you want to have at least 1 million shares a day of the stock traded. Do we have that? Check. Do we have an entry on the charts, technically speaking? Check. You know, is the tech sector uptrending? Check. Is the stock uptrending? Check. Is the market uptrending? Check. And then we come over here and say, do we have at least 20 times the number of contracts we want to trade? Check. Is the bid-ask spread 10% or less? Check. So then the next question is, if we were to sell this covered call, you might be saying, Barb, like, this is only 71 cents. It's like you are correct about that. But 71 cents, like if we come and look at this, 71 cents on a $13.75 stock is not nothing. It's 5%. And so if we came out here and we said, if we could make 5% plus the appreciation in the stock, if this were to go up and we were called out. So I call it a buy right covered call. In Thinkorswim parlance, they call it buying covered stock, because we're both going to buy shares of the stock and we're going to sell a covered call at the same time. And the goal here is to be called out. So the most we could make on this is just shy of $200, because we can't, if it goes up to 20 bucks, we'll be called out at 15. And so if we said, okay, well, if I could make, or we could make on this example trade $1.96, and I divide that by $13, that sounds like about 15%. Like if I'm trying to do math numbers in my head, well, it is 15%. So then the next question you have to ask yourself is would I be happy with a 15% return in 25 days? And if your answer is no, then don't place the trade. But if we said, yeah, I'd be okay with that. So how many contracts could we do? If we did 4, we'd be just over that 5,000. So if we say, okay, we're okay with doing that. Now, what's the next question is how do we manage our risk to the downside? And I met someone at a Chicago event last year or the year before. And his goal was to make 6 figures. And I have no idea what his account size was, but he really liked this buy right strategy. But he said, but I can't protect myself to the downside. It's like, yes, you can. It's like, well, I can't because if I put a stop in on the stock, then I'm left with a naked short call and that has unlimited risk. And so I showed him how to put an exit in. So we're going to put an exit in. And where might we put that exit? Well, we might say, here's our recent low was 12.13. So I could put a stop in 3% below that. That would be at about 11.76. So this would be a potential stop. And so if we put our stop in there, then how much are we risking? Well, we're risking 1176 minus 1306. We're risking 1306 minus 1176. We're risking $1.30 a share. So if we did 400 shares, we'd be risking $520. Now, there isn't a guarantee that we're going to get out at exactly the price requested, right? Right. We know that. So, but that's our max loss. Now, you might say, but what if, if we go back here, really to about December, this 30-day moving average has been acting as a support level. So what if we went to 1072 and went 3% below that? Well, that would be 1039. And here's one of the things, I had a friend, he put his stops so tight and then he'd always get frustrated because he'd get stopped out. Okay. So here's the thing. If we put our stop down here, the probability of being stopped out is going to be much lower. But if we are stopped out, we're going to lose more. How much more? $1.50 a share more. Well, let's see, 1039. So if we're paying 1303 minus 1039, so we're risking 264 cents, $264 a contract. So now we can't do 4 contracts. We can only do 2 contracts. And we can tell, our gut instinct tells us that the probability of being called out is lower, but can you show me some stats? And I can't show you exact stats, but if we come to the trade tab, and this is another thing that we can use the option chain for. If I come here and look at, this June 5th expiration, which is what we're looking at, and I look at the 1150 strike, which is, just below, I've brought up probability of touching, which is something you can add to your option chain. If you want to customize it, you would just come here and then come down to customize. And then you can type in probability of touching and add that. So the probability of it coming down and nicking if we were at 1150 is 35%. Okay, even though the delta is 14, and some people use that as a proxy, that the probability of it coming down and just giving it a little smooch, and all it has to do is touch it. So you're kind of going, well, that, isn't great. And so, but if we put a stop at 1039, then the probability of it coming down and touching that 1039 versus 1150, we go from 35% to 17. We cut the odds in half. Now, what other choice do we have? Well, we could put in a stop around 1150. We could buy a protective put. And so we're spending 22 cents, to buy that put, but then it gives us the right to sell the stock at 1150 at any time between now and expiration. So that's another choice that we have to protect our position. And so we're taking a little bit of this money that we've made from selling this covered call. We're taking 22 cents of it to secure some protection to the downside. So here's my question, and I'm going to put this in the chat and then we'll, so Nokia is, do we do a protective put or the stop loss with 200 shares? Okay. And if we do the protective put, then we could do 400 shares or 300 shares. Okay. Oh, sorry. So guys, I didn't phrase that question right. So it's like, do we do the protective put? Because you guys can't say like protective. So do we do the protective put versus the stop? Okay. Okay. So it looks like the protective put. So bogus chinchilla, you're right. Which is no and which is yes. Yeah. Yeah, you guys I'm usually better about that, but it's Monday, So yeah, so I've got yes to the put, yes for protective put. Okay, so we're going to do the protective put. So then what we're going to do to create this protective put is I'm going to come back in here. We are going to buy our covered stock. And then I'm going to change this advanced order to first trigger sequence. And we're going to come down to this 1150 put. And I'm buying a put. And so if we do 3 of these, so now we've got coverage to the downside. Okay. And now this is trading at 12.98. Plus we're having to spend 22 cents. 12.98 plus 22. So we're spending 13.20. So the most we can make is $1.80. And we're dividing that by our, call it 13.20 divided by 13.20. That's still a 13.6 potential return. Okay. And then we're honoring our position sizing rules. And so it's saying the most we could make here is $600. Now you have to keep in mind, and you may say, well, that's not going to have me drinking something out of a coconut and Tahiti. No, but it buys a lot of gas, even at current prices. A lot of virtual gas, paper money gas, or, like our goal in this class, and our goal for this year actually came from a client who typed into the comments, there's no way with a $25,000 account that you could make $100 a week on average. And we've already done that this year. So we said, okay, our goal is going to be to make $200 a week on average by the end of the year. And that may seem like a lofty goal. And some weeks we've made way more than that. And some weeks we've made less, but this would cover 3 weeks worth of that $200 goal. And I think it's just really important that you have, that you have a goal with your trading. Like, why are you doing this? This isn't a hobby, right? Right. Okay, so we're going to send that in. Okay, so that's our first one is Nokia. and we used a protective put instead of a stop loss order. Okay. Okay. Now let's go look at NVIDIA. Today is not officially sponsored by the letter N, but I just noticed our first two trades. So with NVIDIA, we were doing iron condors in this class for a while. And where we were selling a short vertical below 170 and a short call vertical above 198 until that stopped working. And now it's broken through, and it had been trading in this range for quite a while, right? Since September of last year. And then it broke out, kind of caught its breath, came back to retest, and is hitting a new all-time high today. And you may go, like, what is it with you and these all-time highs? And that wasn't deliberate. But, if we look at this and when we see, well, we've got earnings coming up. Okay, I didn't notice that. And today is the 11th. And I was looking at a long call vertical, but what can happen with earnings is stuff can gap up or it can gap down. Like the last earnings report, it moved down afterwards. And so one of our rules, if we're doing a long call vertical, is that we don't trade it over earnings. But what I had seen that I thought looked appealing here was that if we came out to say June 25th, our bid-ask spreads are very tight. We have tons of volume that we could have done, say, the 215, and something that it's already through both strikes. So with this trade, we want it to go through both the 215 and 220 and stay there, and it's already there. And we could still, put in a target around $4 and make our 50% profit, but earnings is the 20th. And so, yeah, so no deal, Lucille. So I know I've talked about trading plans a couple of times and where might one find these? Well, we're going to come over to, if you haven't subscribed to the Trader Talks channel from Schwab Coaching, it's a free resource that you can access. So if we come here, you'll see what you'll first see is whatever's currently being taught. And then if you come to playlists, if you scroll down to, it's called the Trade Management Mini Sessions, and I've just created this folder. And the first group is short videos. Most of them are under, they're 2 to 5 minutes long on different candlestick patterns, which I often talk about in this class. So you can do some binge learning if you're interested there. But here's our example trading plan for a buy right covered call. And this is the one we're using in this class, but this you can use as a framework to create your own example trading plan. And it would include when to trade, what to trade, what criteria do you want the stock to have to meet? So, or in our case, when to buy, what to buy, how much to buy, position sizing, when to exit, both if the trade goes for you or against you, and then what are your routines to manage it? And then here's our long call vertical example trading plan, which I just re-recorded. So if you haven't watched it in a while, after they've been up for a couple of years, we tend to bring them down and I'll re-record these. But that's where you can access those. And then the other thing I wanted to point out on this page, if you missed the National Investing Day, there were 6 sessions over the course of the day. They're just shy of 100,000 views. And so if you miss these, you may want to check them out. How to vet stocks for long-term investing, retirement strategies depending on age and stage, wealth management, etc. Essential rules for beginner investors, Kevin Horner and James Boyd. They do a class together every Friday. If be there, be square. That's all I can say. It's a great class. Okay, so having said that, let's go look at RMBS. So with RMBS, So was it Nokia just had earnings? So Nokia has already come with earnings. So, and we're only in that trade for 25 days. So it doesn't have another earnings announcement. Yeah. So with a buy right, we did an example when I was filling in for Cameron May on doing something over earnings, but in our example trading plan, we avoid trading that over earnings. Now that's in our example trading plan. So Jim, good question. Your example trading plan, the advantage of trading a buy right covered call just before earnings is that volatility tends to be higher, so you get paid more for the covered call. But if the stock gaps down, it can be painful. And if it gaps up, you might wish you had, sold something else. Now, my take on it is if it gaps up and you're called out, now you're never called out early in paper money, but you've just got your max gain faster. And so one should expect to see people dancing in the streets, champagne being popped, whatever. Nokia, no, Nokia came with earnings on April 23rd on Nokia. Okay, so RMBS. So RMBS got hit on earnings, which is interesting because when I looked at it, the estimates were for 55 cents a share. It came in at 63, but it kind of took like a 1 day hit and then is moving back up. It's up 44% year to date. If we come and we look at, if you're not familiar with this company, again, in the tech sector, which has been crushing it, based in California, founded in 1990. So it's been around for a hot minute, does, interface chips, et cetera. So it's in the semiconductor space. If we come out and look at live news on this company, and let me come back to the charts. So Jefferies maintains a buy target of 145. Well, it's currently at 132. Rosenblatt raised the price target to 150, Wells Fargo to 145. So it seems to me we're seeing more raising of targets than lowering of targets. So could we come in and do something and say, well, hey, it's trading at 132. These guys all have targets higher than that. Not that they're right, no guarantee that they're right. But, how heavily traded is it? Well, if we come down and we look at the volume bar, yesterday it was 2,000,002. Today it's a little lighter so far, but we're still pretty early in the day and it's already at 859,000. It only offers monthly options. And so sometimes you're going, I don't know if that's going to be heavily traded enough. But if we're looking at the 130 and the 135, because on a long call vertical, we tend to bracket the current price in that we buy the first strike in the money, which is not in our snack bracket to buy a $1,400 call. Remember, if you buy a call, you could lose the entire amount that you pay to buy the call. So what we're going to do is then sell the 135 call, which means we, then have the right to sell the stock at that price. But then if we receive 12.10, then we're not out as much. But, the bid-ask spread is acceptable. When we're looking at buying a vertical, this has to move up by, $2.66 for us to have ultimately our max gain. But what we've decided with our example trade, that even though the potential return is over 100%, we're saying we are not going to be greedy. If we can make a 50% return on this, we're going to be happy campers. And so we are going to make this a first trigger sequence. How many of these are we going to do? 2, because 2 has us risking 460. We're not going to risk $690. That breaks our position sizing rule. So we're going to take 230 times 1.5 and say, hey, when this gets to 345, we're out. We've got a 50% return. We're happy. Okay. we said we're not doing, as part of this, the buy right covered call trading strategy, our example trading plan, if we're trying to do it as selling something that's in momentum, we tend not to do that strategy with with earnings between the time we place the trade and the expiration. So I didn't say we don't buy stock before earnings, but if we're trying to trade that strategy based on momentum and in a more conservative way where it's less likely to be derailed. Okay, does that make sense? So Joanna, I hope I've answered your question. So first trigger sequence, we're going to right click, create an opposite order and say, hey, when this gets to 345, get us out. And, you know, we could make $230. That's our weekly goal, right? You know, if we could make, and we're going to have trades that don't work out. We're going to have weeks that don't work out. You know, and that's part of the life of someone who is an active trader, you know, and this is just an example. And so we've got that one in percolating. And so we've done a buy right covered call and we've done a long call vertical. So how about we look at, this is a stock in the energy sector. Now, some people might say, well, I'm kind of avoiding the energy sector these days. There's a lot of volatility. But if we look at this, you know, today's pattern, I was going to suggest we do a conditional order on this because it was trading a little lower, but this pattern is both a hammer, you know, at a potential support level. It's also a Harami pattern, which is this body is totally inside the candle of this body. And so, you know, a conditional order is now no longer necessary for this stock. But, you know, year to date, this stock is up almost 18%. The other thing that some people may have noticed is that it has a PE ratio of under 20. So a lot of people, if they're looking for a stock that's in that value category, they might find that appealing. It also has a dividend yield of almost 7%. Now, one of the differences between paper money and a live account is that in paper money, you don't actually get paid dividends. So woe is us in our paper money account. In a live account, those would be paid, but there isn't a guarantee that they would continue to be paid. Yeah. So, you know, that's something for us to be aware of. But you might say, well, I can see the appeal. And so, you know, a dividend was just paid on this. So that might be the reason for this candle because, you know, the day, you know, of a dividend payment, we tend to see a pullback. But, you know, could we buy a call here? Or, you know, we could also buy the stock and do a swing trade. You know, and what do I mean by a swing trade? Well, you know, we had a previous high here that it hit just a few days ago of 2067. What are the analysts? We just had earnings. Well, Citigroup raised their target to 23, Stifel to 25. You know, so could we just say, hey, I'm going to buy 250 shares, which would be about $5,000 worth. I'm going to buy 250 shares. And when it gets back up to 20, you know, or $20.50, you know, so I'd just make a buck. And you might say, well, a buck, like, is that even worth it? Well, like if we change, you know, if we look at our calculator here and say, well, if I put in a target of say 2050 and I made $1 on, you know, that's got to be 5%, right? On a $19, whoops. If I made $1 on a $19.46 investment, that's 5%. Like that's not too shabby. You know, beats a poke in the eye with a sharp stick, as I like to say. So how would we do that? And then where would we put our stop? Well, one of the nice things is that this is at a support level. So we could just take today's low of 1914 and multiply, say, if it goes 3% below that, not going in the right direction. Now you might want to make that number 5%. You can make it whatever you want, 1856. So we're risking just shy of $1 per share to make $1 a share. So we're going to come to the trade tab. We are going to right click. We are going to buy custom with both a target. So our target is going to be 2050. Our exit's going to be 1856. And we're going to change this number. If we do 250 shares, that's about a $5,000 position. And then I'm going to change my little firecracker to a paper clip. And then when I click anywhere here, like I'm going to change these till good till canceled. So now these match up. So, we're looking to make $1. That's our target. And our exit is 91 cents below at 1856. Our position size, 4,867. So it honors our position sizing rules with respect to the size of the position and how much we're risking on the trade. And again, if it gaps up, we could get out and end up making more. If it gaps down, we could end up making less. So we're going to put that in our stock with targets group. Now, we only have a couple of minutes left. So I want to talk about JP Morgan. I said there was one position. So we're underwater on JP Morgan to the tune of $130. And our strikes on JP Morgan, we did a short put vertical. So the goal was for it to stay above 305. It's currently at 300. It was at 301.50 when I looked earlier this morning. So it's almost through both strikes. But the interesting thing is that even though it's through both strikes, our max loss would be if it was this number was worth $5. So we still could lose another $225 on this. Okay. But if it's below this strike and this stock was put to us, what would we do? Well, we do what we could do is then now it's trading just underneath, is go in and exercise our right to sell it at 299. Then we would have our max loss. Now let's go look at it on the chart. So when I looked at this earlier, it was a bit more of a hammer type pattern, but we expected it to stay above here. And when we put the trade on, it was probably on a day like this. Let's see, when did we put the trade on? So we can come here to view trades, April 27th. So this makes sense. That was a bullish engulfing day. And we were just expecting it to stay above this 305. Well, it hasn't. And so what we might say is, hey, this has broken this support level. And even though we have, 2 weeks, it expires a week from Friday, we are going to exit this position because it has broken this support level. Others might say, hey, I position sized appropriately, so I'm just going to hang tight and see if it turns around. But we are going to exit this position. And it could end up turning around, but you just have to make the best decision you can with the information that you have at the time. Okay. And this was in our short put vertical group. Okay. So that's our trade management for today. So what did we do today? We did a buy right covered call on Nokia where we used a protective put instead of a stop loss order for protection to the downside. With RMBS, we did a long call vertical. And if it's up 50%, we want out. If it goes down 50%, we want out. We close the position that broke a support level on JP Morgan. And then we put in an order. Let me just go by time placed. To open a position on ET. Well, it's now saying they want us to pay 3 cents more. So you know what? We'll cancel and replace this. And we'll give them the 3 cents they're looking for. Okay. So that's what we did today. So guys, thank you for joining me. There is a link in the survey. 1 means you hated it. There's just 2 questions. 1 was I hated it. 10 was I loved it. You can put comments in. I promise to read them, as will the management team. If you'd like to give, some insights on what you'd like to see in upcoming classes, hit the like button, subscribe to the channel, and don't forget to follow Kevin and I on social media. Hope you've enjoyed this and found it helpful. Have a really awesome rest of your day. Thanks to Kevin and the guys behind the scenes for helping this class come to life. Take care, everyone. Bye for now. Up next, Mr. James Boyd, so stay tuned.